Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Byte. We're shooting this episode on 19th of June, and the markets almost hit a all-time high today. I think the previous high was 18,887 and we went to 1800, 18,800 odd, just missing it by a few points. The jitteriness just before hitting a all-time high is obvious, just like Mr. Tendulkar also did in his 90s on many occasions. And that is not any indication that the market is weak or anything. It is just that uh, at such crucial points, there are two very strong camps in the market. One which is looking at a breakout and much further rally to happen, and another camp which is now looking at a very opportune time to make a double top and try to bring the market down. So these two camps are slugging it out at this level, and that is probably the reason why we have some indecisiveness at very near all-time highs. Uh, you can see the Nifty heat map. Some of the large cap names taking a beating today: Reliance, Levers, Nestle, Tata Consumers, all down nearly a percent. Kotak Bank and ICICI Bank, along with Axis Bank and IndusInd Bank. So private banking, barring HDFC Bank, were almost all down. Some selling also in auto stocks, Maruti, Tata Motors, Aisha Motors. Some in cement and steel and energy stocks also. The only sort of green you can see here or neutral areas were some consumption stocks like Titan in Asian Paint, ITC was flat, L&T in infrastructure was flat, Tata Steel was flat, Infosys, Wipro also flat, TCS and Tech Mahindra gained a bit. Some finance and insurance companies also gained. So that was the mix for the Nifty today. And you can see that the entire banking pack was not down. PSU bank stood out at plus 1%, and private banking was down almost near 1%. Very polarized day for with private banks giving up a percent and PSU banks gaining a percent. Still, the bank Nifty was down 0.7%. IT stocks second in the gainers list at 0.4%, pharma at 0.2%. Pretty much defensive sectors, IT and pharma went up. FMCG, although being a defensive sector, also was down at minus 0.6%. So just a bit of, I would think, nervousness before the new highs, and this kind of nervousness was not seen in the Nifty mid caps, which broke out of their previous high at 33,200, now at 35,158. So even with today's intraday fall, the closing was very near previous day's close. So no give up as such has happened. Small cap index on a larger view, you can see, has broken out of this flag like formation and has also hit a new all-time high. This is more of a close-up where you can see intraday a new all-time high was hit, and on closing basis also a new all-time high. On small cap 250, a new all-time high has been hit, and also on BSC small cap index the new high has been hit. There is one more small cap index, small cap 100, which is yet to hit all-time high, and there is some way to go for that. So and the most important sort of component which was dragging the market was private banking, and Nifty Bank remaining in the 43,600 zone. So last three sessions have been extremely volatile. We had a very sharp Thursday fall, then we had a really sharp Friday upswing, and today we had a sharp fall again in Bank Nifty. So very indecisive moves in Bank Nifty. It has been caught in this box for almost 40 days now, since the second week of May. and has not been able to clear the previous high decisively. So there is a correction driven by the bearish here. Um, let's see where this goes. But the internals of the market, the broader base of the market, the small caps have not had this problem what the large caps are facing. So this is predominantly, most likely, a FII related issue, that there are sellers selling happening in the institutional space, while domestic institutions continue to buy on this. So the topic for the discussion today is all-time high on caps, and how this today's all-time high versus previous all-time highs when they had happened, how have the markets behaved, and we'll study that data from peaks to troughs. So this is essentially last 20 years of data. uh, and the black line is the small cap 250 index, or possibly this is the CNX small cap 100 index, because it is yet to go to a new high here. And this is the orange line is the Nifty. So first thing to note is that the small caps and mid caps and large caps mostly, with a very high probability, will hit a top and a bottom together. So you can see here 2008 you had tops on small caps and large caps together. 2009 you had bottoming of both together. Then 2010 sometime you had top on small caps. Almost there you had a intermediate top on Nifty as well. Then you had a 2013 bottom on both of them. This is a weekly chart actually. uh, then again you had a top, intermediate top somewhere beginning of 2015, then a bottom here at 2016. Again, this was one occasion in the last 20 years because of the SEBI change of rules, where small caps were demolished starting 2018, or rather 2017 December, and large caps continued the rally till both of them were in unison again when the COVID struck. So this one fall of small caps while the large caps were rising was one uh, event, which was sort of engineered event, where the SEBI forced mutual funds to restructure their and the exposure to small caps, and a lot of small cap exposure was sold off and possibly gotten into large caps, and hence the divergence in these two trends for that period of time when this was happening. And then again, post that, you saw bottoming of small and large caps together here, and somewhat a high made in small caps here, but uh, large caps made a high just couple of months before that. And then the bottom again together here, also bottom again together. So you can see here that the moves are pretty much in unison at least 90% and above of the time. Now, if we look at it in a granular fashion, then from the top of 2008, which was a huge rally from 2003 to 2008, Nifty is up 205%, small caps are up only 86%. So this is very, very counterintuitive that, in the last 15 years from that peak, Nifty has performed way better than the CNX small cap 100 index. I mean, I would not have guessed this if I was to think about it, but on the charts, it is very, very evident. Next peak was 2010, intermediate peak. Again, you can see here Nifty has performed 212% versus 142% on the small cap index. Peak number three, 2015, Nifty has again performed better at 111 versus 89.92. Fourth peak, January 2018, just before small caps were crashing. Nifty is up 78%, small cap is up 13% only from here. Now let's come to the troughs, the bottoms of these uh, falls. So 2009 fall, from that bottom, of 2009, small cap is up 646, Nifty is up 579. So marginal advantage of small cap, and not even calculating the dividends here. Nifty has better dividend yields than the small caps here. So marginally better even from the worst position of the trough in FF 29. From 2013 bottom, yes, small caps are up 313% versus Nifty at 243. From COVID bottom, small caps are up 210% versus Nifty at 132. And from very recently, April 23 bottom, small caps are up 24% versus Nifty. So, what is the conclusion or insights from here? That there is not over a period of 20-25 years, both these indices, there is not so much of a continuously increasing gap between small caps and large caps. And the primary reason for that is that whatever stocks are doing the best in a small cap index actually don't remain in that index, and they move to the mid cap index, and from the mid cap index they move to the large cap index. So it is actually not the survival of the fittest in the small cap index, but the removal of the fittest which is happening over a period of time. So comparing small cap index and large cap index, this is one major difference. Whereas in Nifty, if a stock is really outperforming all others, it stays in Nifty. That performance stays in Nifty. The second sort of insight from here is that the allocation part. So, what we are seeing is that you need to be in the small cap index when it is coming out from the bottoms. If we are catching the small cap index at the peaks, then Nifty is outperforming the small caps. But if we are trying to catch the small caps from when it is bottoming out, there is the real sort of advantage of small caps that comes around. So, what we can do is that have a strategy where we don't go through the entire bottoming of small caps in our portfolio. So, for instance, in momentum investing, if we have an absolute strategy, maybe like MI25, MI50, etc. When the market goes down and the small caps start to go down, they will go to cash, partial cash, full cash if market really goes down. And then the market keeps going down while you sit at cash. And then when the markets start to bottom and come up, and the leaders of that rally when they are starting out, that is where the strategy will pick up the constituents for the rally up, and that's how they start to outperform from there. In relative momentum strategies where we don't go to cash like MI35 or MI20, what will happen is as the markets come down, stocks that are falling more will get rotated out. Stocks that are falling less, so which are likely to be defensive stocks, FMCG, IT, uh, pharma, which will fall less than the high risk stocks. They are the ones that will get rotated into. So your portfolio rotation will change, and once that bottom happens, and there are winners from other areas like autos or defense or some other sector which is really rocketing up, sugar or some other commodity, that is when those defensive stocks that are in your portfolio will rotate back into those high flyers again, and hence you will get that kicker. So having that strategy of not allowing your portfolio to go to those troughs, but when the market starts back from the troughs, for you to switch into those leaders of that particular rally. Every rally will have different leaders, so you need to have a function to how to get into the leaders of the current rally, because you could be sitting with the leaders of the last rally, Graphite, HEG, Rain. I can rattle off 50 names which did very well in one period, but then they did not do so well in the next 6 years. So you cannot keep sitting on those laurels from the past rallies and keep hoping that they will keep performing in every rally. In every rally, the sector will change. In every rally, new leaders will come. So to have that new leadership, you need to have a strategy which will rotate into your portfolio automatically by the virtue of the best performers in that period. And allocation to small caps by rule-based strategies can help reduce the weakness of the downside, as I've already talked about. So essentially, the message is that do not hesitate to have exposure to small caps, have exposure to small caps, because small caps are the real kicker when it is coming out of that bottom, like we've also seen in the last 6 odd months, like from this position from mid of 2022. If you see, small caps have really done well in many of our strategies also. So this is where the real kicker comes, and then when the markets do slump at some point of time, you need to get out of them before the entire gains are washed out like this. So, like when the market is falling like this, maybe somewhere around here, you will get out of most of the stocks, set in cash, or go into defensives. When it is falling from here, maybe sometime around here, you'll get out of stocks and set in cash, set in cash, and then maybe somewhere get allocated here. So this is the sort of quant way and the rule based way in which you will not have to go through that emotional roller coaster also, which these falls can really bring about. And this actually is the precipitation of the most weakest of hands in the markets that happens. So you are long here, you've seen this top, now market is falling, you don't know what to do, you're averaging, you're waiting, then this happens, then there is despair, and then this happens, you said, oh, stock market is the worst place to be, let's throw it all away. And that is where the new life of a rally is born. So this is a cyclical process that will continue to go on every few years. You just have to have your process right, and that's how you can continuously compound and make money in the markets. This is one of our strategies, MI35. You can see here from September 2020. It's gradually outpacing the underlying index since going live. This is another MI20 strategy, which is mid and small caps. Again, gradually outpacing the underlying benchmark and going up. MI50 is a 50 stock strategy. Now, a lot of people say that 50 stocks is too many stocks to have. More than 15, you cannot perform. But just see, in the last 2.5 years, it has outperformed in a good way. And over the last 8 years, actually, that we've been running this live, even before small case happened, it has outperformed all strategies. So many strategies are there which can outperform the benchmarks and outperform the markets. You only need to keep the discipline. You only need to keep your wits together when the market is against you, and keep the process. Keep following the process, and that you'll see the other side of the good side of the market very, very soon. So thank you so much for watching this, and I will see you in the next one. Thank you. Bye.